So why on earth is a 140-year-old industrial gas company trading like a hyper-growth tech stock? The market has just handed Linde PLC a massive 33.6 times price-to-earnings multiple, and it's for one very specific reason. They hold a critical, inescapable supply chain chokehold on the global artificial intelligence and semiconductor megatrend. You see, when we talk about AI, we usually think about software, algorithms, and those advanced microchips. But beneath all of that digital magic is a harsh physical reality. There is a massive physical infrastructure requirement that is entirely bottlenecked by the need for ultra-high purity gases. And the absolute proof of this is hiding in one staggering number, $7.1 billion. That is Linde's current project backlog, and it is heavily driven by building the ultra-high purity gas plants that are absolutely essential for global semiconductor fabs. Look, if you want to build advanced chips for AI, you literally cannot do it without what Linde is building. When you picture the AI boom, you're probably picturing coders in Silicon Valley, right? Not an industrial company founded before the Wright brothers even invented the airplane. Yet, here we are. So, let's break this down. Let's see exactly how an old-school industrial utility quietly became the toll booth for the entire tech boom, and whether or not that sky-high valuation is actually justified.
To understand why Linde is so completely critical right now, we need to quickly look at how they actually make money. Think of them as a highly localized, essential utility. They extract atmospheric and process gases, things like oxygen, nitrogen, argon, hydrogen, and helium, and deliver them to customers. And they do this in three main ways. The first is on-site, and this is the big one. This is for massive, ultra-high-volume clients like chemical complexes and, crucially, semiconductor fabs. Linde will literally build a cryogenic air separation plant right on the customer's property and then plug pipelines directly into their manufacturing line. And they do this under ironclad 15 to 20-year contracts. The switching costs here are totally prohibitive. You can't just unplug a factory. The second method is merchant, which uses bulk liquid tankers to deliver to medium-volume customers. And the third is packaged gases, where they deliver high-pressure cylinders through local trucking routes. The big takeaway here? Linde isn't just selling some replaceable commodity. They are integrating so deeply into a customer's infrastructure that the customer physically cannot operate without them.
And this business model creates an absolute fortress of an economic moat, mostly built on geographic network density. The global industrial gas industry is a consolidated oligopoly. It's dominated by the big three, but Linde really stands apart. They are currently operating at a phenomenal 30% trailing operating margin. That completely dwarfs their closest competitor, Liquide, which is sitting down at 19.6%. So how do they pull that off? It comes down to last-mile distribution efficiencies. When you have incredibly high plant density in a specific geographic region, your transportation costs absolutely plummet. You can fill tanker routes way more efficiently than anyone else. Plus, Linde operates over 1,000 kilometers of high-purity hydrogen pipelines globally. Once those pipes are in the ground, it essentially creates a permanent geographic monopoly. Competitors are simply not going to spend the billions of dollars required to dig up the earth and build a parallel pipeline network.
Now, what is really fascinating here is the sheer velocity of their total addressable market. We are watching it expand from an estimated $115 to $143 billion in 2025, scaling up to $157 billion in 2026, and it is projected to rocket to roughly $231 billion by 2030. We're talking about a compound annual growth rate of roughly 9.4 to 10.2%. And what's fueling all of this massive expansion? Well, it's not just traditional welding or healthcare anymore. It is the clean energy transition, its carbon capture technologies, electric vehicle manufacturing, and above all, the voracious, unstoppable demand for high-purity gases in advanced electronics. Linde has positioned itself at the absolute intersection of all these modern megatrends.
But we have to pause here, because this brings us to the ultimate tension of this entire story. The market is constantly wrestling with one major question. Does a 140-year-old industrial utility truly deserve a 33.6 times tech-like multiple? Because beneath all of those flashy AI tailwinds, Linde is still deeply exposed to highly cyclical heavy industries. We're talking steelmaking, chemical refineries, and traditional legacy manufacturing. The bear case here is actually incredibly smart, and it's well-grounded. Investors are terrified that a stagnant European industrial sector, combined with a potential synchronized global slowdown, could just act like an anchor and drag down those pristine margins. In fact, high local electricity costs in Europe have already caused volume declines for some of Linde's chemical and metals clients. The fundamental conflict here is whether the explosive, AI-driven electronics growth is strong enough to outpace the heavy, dragging weight of traditional industrial stagnation. To answer that, Let's look at the cold, hard evidence from their Q1 2026 earnings, which just dropped on May 1st, 2026. They reported $8.78 billion in sales, which is an 8% increase over the prior year, beating consensus expectations. But the real story is hidden in the segment breakdown. In the Americas and Asia-Pacific segments, underlying sales grew by a really strong 6%. That APAC volume growth was heavily driven by electronics, chemicals, and energy. But then look at EMEA, Europe, the Middle East, and Africa. We actually saw a 2% underlying sales contraction there, driven by a 3% volume drop in chemicals and manufacturing. And yet, despite that volume drop, they still posted a staggering 36.1% adjusted operating margin in that exact region. How? Pricing power. They simply raised prices by 1% to help offset the volume drop. Across the entire company, they achieved a beautifully stable 30% adjusted operating profit margin and an adjusted diluted EPS of $4.33, beating analyst estimates. Essentially, what happened is the massive growth in high-margin advanced sectors completely absorbed the European industrial contraction.
And this dynamic is exactly what served as the catalyst for the stock's massive recent movement. During that same Q1 2026 announcement, management updated their full year 2026 guidance. They actually raised the bottom end of the adjusted EPS range to between $17.60 and $17.90. That signals a projected annual growth of 7 to 9%. But this wasn't just a quiet spreadsheet update. CEO Sanjeev Lamba specifically came out and highlighted that the electronics end market grew 10% year over year, explicitly driven by advanced chip investments to support artificial intelligence. He confirmed the company is currently pouring over $1.0 billion of their backlog strictly into ultra-high purity gas plants targeting global semiconductor fabs. On top of that, they are capturing massive pricing gains in the global helium market right now due to supply chain shortages. This commentary sent an incredibly clear message, driving Linde shares straight to a 52-week high of $538.95 shortly after the announcement, with equities analysts quickly scrambling to raise their price targets up to the $550 to $575 range.
So the crucial takeaway here is understanding the fundamental business quality that is driving those numbers. When you synthesize the qualitative scorecard based on all this research, it paints a picture of extreme, almost bulletproof durability. Revenue quality scores a perfect 10 out of 10. Why? Because of those on-site pipe networks we talked about. They are locked in under 15 to 20-year contracts with take-or-pay clauses. That means Linde gets paid a fixed baseline revenue whether the customer actually consumes the gas or not. And they come complete with inflation-indexed cost pass-throughs. Capital allocation also hits a perfect 10 out of 10. Management returns $7.4 billion to shareholders in 2025 through dividends and buybacks while still fully funding their double-digit return growth projects. Market position is a dominant 9 out of 10. The only slight moderation on the scorecard is the growth outlook, which sits at an 8 out of 10. And that perfectly reflects that central tension we discussed earlier. Incredible secular tailwinds from semiconductors and blue hydrogen projects, but just tempered slightly by broader macroeconomic moderation in legacy-heavy industries.
By the way, if you're into this kind of deep, research-backed stock analysis, you'll probably want to hit that subscribe button.
Real quick, all of the research behind this explainer was created using Flash by Stock Sentinel AI. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash is a premium feature called Best Ideas Now. Every single week, it surfaces the highest conviction ideas across 3 distinct investor styles. Long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. They also have Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code right down there in the bottom right of your screen. Scan it to download the Flash app and try it yourself. Or just access Flash on the web at flash.stocksentinel.ai. Pricing goes up over time, but once you lock in your subscription, your price never increases.
All right, let's dive into the valuation framework. Before we look at the exact numbers, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is absolutely not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these modeled scenarios.
Let's map out the 5-year scenario analysis spanning fiscal years 2026 to 2030, anchored against a starting share price of roughly $506. We are looking at 3 distinct operational paths. First is the base case. We assign this a 65% probability. This assumes Linde's compounding model stays right on track. Operationally, this means industrial gas demand continues to be supported by heavy secular semiconductor and electronics growth. That drives a 5.5% annual revenue compound growth rate. We model adjusted net margins expanding to 24.5%, driven by efficiency gains, price adjustments, and the completion of high-margin backlog projects. Crucially, they continue buying back their own stock, reducing shares by an average of 2.2% every single year. So what's the math on that? By year 5, this drives revenue to over $44 billion. It pushes adjusted earnings per share to $26.29. If you apply a historical 27 times exit price to earnings multiple to that, it yields an implied future share price of $709.89. When you include an estimated 8% annual dividend growth, you are looking at a total return of 47.62% or an annualized return of about 8.1%.
But let's be real, things don't always go according to plan. What has to happen for the low case, the bear scenario, to actually materialize? We assign this a 15% probability. Operationally, this would require a prolonged, painful global industrial slowdown. Think soft manufacturing demand that completely caps revenue growth at just 2.5% annually. Energy inflation and feedstock costs bite hard, compressing net margins down to 21.5% because price increases just fail to fully cover rising input costs. Free cash flow drops, which slows share buybacks to a much more conservative 1.5% a year. Under these tougher conditions, the market strips Linde of its premium AI multiple, derating the valuation to a 22 times PE. That implies a year 5 share price of $424.03. Even if you factor in a conservative 5% annual dividend growth, this scenario results in a total cumulative return of negative 9.27%.
Now, let's look at the flip side. Contrast that with the high case, a bull scenario carrying a 20% probability. What if the AI revolution accelerates advanced chip manufacturing even further, and those clean energy blue hydrogen projects take off faster than expected? This pushes revenue growth to a robust 7.5% CAGR. Incredibly strong pricing power, particularly in areas experiencing global shortages like the helium market, expands net margins to a very rich 25.5%. This unleashes massive free cash flow, allowing them to accelerate share reductions to 2.5% annually. Because of this incredibly durable growth and secular momentum, the market expands the multiple all the way up to 31 times. That combination creates an implied future share price of $946.27. Factoring in a 10% annual dividend growth, this drives a phenomenal 94.61% total return or 14.24% annualized. And remember, if you want to access the full mathematical model to see every single detailed assumption behind each of these scenarios, you can find the complete research report for free at flash.stocksentinel.ai.
All right, so what could actually break this thesis? What are the specific structural risks you need to monitor? This isn't just about general stock market volatility. First, you have company-specific execution risk. That massive $7.1 billion sale of gas project backlog requires highly complex engineering. If they hit delays in schedules, equipment logistics problems, or supply disruptions in critical turbomachinery, that leads directly to cost overruns and deferred revenue. Second is the competitive risk in those stagnant regions we discussed earlier. If high European electricity costs continue to ruthlessly pressure clients, competitors might start engaging in regional price concessions just to keep their physical assets utilized, which would directly threaten Linde's margins. So, what are the early warning signs investors should actually watch for? A major red flag would be sequential quarterly declines in adjusted operating margins, followed by a flattening or shrinking of that multi-billion-dollar project backlog. If we start seeing volume contractions spread from Europe into their absolute strongest market, the Americas, that is a clear, flashing signal that a synchronized global recession is severely impacting their more vulnerable merchant and packaged gas segments.
Which brings us right back to the central mystery we started with. Does a 140-year-old industrial gas company really deserve a massive tech multiple? As CEO Sanjeev Lamba explicitly pointed out on their latest earnings call, the electronics end market grew 10% year-over-year, driven by advanced chip investments to support artificial intelligence. The market isn't valuing Linde based purely on its legacy steel and chemical clients anymore. The market is pricing in the stark reality that Linde has completely positioned itself as the inescapable toll booth for the entire global AI and clean energy hardware build-out. You simply cannot build the advanced semiconductor fabs that power the AI revolution without the ultra-high purity gases and the billion-dollar-plus on-site infrastructure that Linde provides.
They are not just selling a commodity. They are selling a highly defensive, heavily contracted 15 to 20-year infrastructure monopoly at the absolute bedrock of the modern technological supply chain. That is the compounding engine driving this stock. But it leaves us with one final fascinating question to watch. As AI spending transitions from building the physical infrastructure to demanding actual software profits, will LIN's physical toll booth prove to be the safest, most resilient investment of the entire AI boom? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.